Hello and welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
We do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment.
Policy right now, since it isn't having, at least in my view, such a strong impact on actual things going on in the economy right now, it means that the risk of being wrong with policy is actually somewhat lessened.
We saw European Union President von der Leyen say last night, those retaliatory tariffs are coming back. Now, I've talked to folks in Brussels. I think Brussels would like to negotiate a détente there, but if Trump doesn't show interest in a deal, we're going to see European tariffs on American goods like distilled spirits, like motorcycles, like, iconic American clothing like Levi's jeans. So I think we're going to be in for some friction over the coming weeks.
We got 1 hour to go until the market close. We're taking a look at the major averages, but once again, even though there may be friction on the trade geopolitical front, there ain't no friction in the markets, or at least not much, right? We've got the Dow taking a little bit of a leg up, but really kind of unchanged for a lot of the day. Right now, it's up a third of 1%, about 132 points. The S&P 500 only up about a tenth of 1%, but again, been trading in sort of a narrow range. And the Nasdaq is down about a tenth of 1% here.
Yeah, big headline today was, of course, Fed Chief Jay Powell before Congress talking to our lawmakers. Julie, I think his message was really simple, to the point, clear cut. Bottom line, the Fed, he said, we're not in a hurry. We're not in a hurry to adjust interest rates. That was a big takeaway. The economy, he said, is doing well. It's resilient, right? We'd like to see more progress on inflation. No surprise there. The policy rate, he said, is in a good place. And of course, the backdrop of that, we know, is Jay Powell and the Fed dealing with a range of uncertainties, a lot of hot talk coming out of Washington in terms of potential policy. He did not want to speculate on tariff policy. No surprise there.
Right. Even as he has talked about how the Fed is trying to model for what tariffs could mean for the inflation data. By the way, of course, tomorrow morning we get CPI. And so that is going to be something traders are watching closely. The 10-year yield moving up by about 4 basis points as we were listening to Powell, but not really changing over the course of his testimony. I'm watching big cap tech again today very closely as well. A couple of standouts. Meta, after dipping this morning, now in the green again. 17 straight sessions is what it's going for here.
Yeah, when we talked to RBC's Brad Erickson on the show, Brad's a very smart guy, knows the company very well. He thought that move, a remarkable move, is justified because he told us this is a story, he said, that has a strong AI narrative, a strong AI story to tell. And he said they're just driving enough marginal revenue to cover the cost for the moment, right?
Yeah.
So investors keep moving this one higher.
The inverse of that I want to mention quickly is Tesla. It's right now down about 6%. If you look at the year-to-date chart, it's down 18%.
Wow.
And if you take it a little bit out longer than that, say, let's look at a 3-month chart here. The peak was in December. That was a record high. Since then, it's now down by about 30% or so. And we're going to talk with the analyst a little bit later about what's going on there.
Okay.
Well, earlier today, Federal Reserve Chair Jerome Powell testified before the Senate Committee on Banking, Housing, and Urban Affairs. Joining us now with more on the hearing is Yahoo Finance's Jennifer Schonberger. Hi, Jen.
Hi, Julie. Besides his opening remarks, Fed Chair Jay Powell gave little and was asked very little about monetary policy during this morning's hearing. Instead, the hearing became a ground for Democrats to ask Powell about the Trump administration's freezing the Consumer Financial Protection Bureau and Musk's role at Doge.
If the CFPB is not there examining these giant banks to make sure they are following the laws on not cheating consumers, who is doing that job?
I can say no other federal regulator.
No one.
In his first comments since Musk gained access to the Treasury's sensitive payment system, Powell offered assurances about the safety of the system and the Fed's funneling of funds to the Treasury.
Confirm for me today, is the system safe today?
I believe it is, and I will tell you, we are very strongly committed to the integrity, efficacy, resilience, and all those things of this system. And people do depend on this in a big way, and we're committed to that.
When asked by Democratic Senator Raphael Warnock whether Musk has attempted to gain access to the Fed's system, Powell said, quote, "I don't believe so. The Fed acts as the fiscal agent for the Treasury processing payments. The Fed also funds the CFPB, which oversees consumer protections for banks." Republican lawmakers were more interested in asking Powell about bank capital standards and the actions of big lenders to debank certain customers. On Basel III, Powell noted that the Fed is awaiting new leadership at the Office of the Comptroller of the Currency and the FDIC to work on revamping those capital requirements as part of Basel III. He says he believes regulators can, quote, "move reasonably quickly," and underscored that he thinks the level of capital at the largest banks is, quote, "about right," and any changes to capital would be neutral. Now, Powell did demur on any questions related to Trump's tariff policies and the impact on the economy and monetary policy. Guys?
All right, thank you, Jennifer. Well, joining us now with more reaction to Jerome Powell's testimony is Richard Clarida, PIMCO Managing Director and Global Economic Advisor. Rich, always great to see you, have you on the show. Our colleague there, Jennifer Schonberger, Rich, was just summarizing Jay Powell's testimony before our lawmakers, but interested, Rich, just to get your high-level thoughts. What did you make of that testimony? What were your big takeaways?
I actually think the chair more or less previewed the message at the press conference, which was not too long ago. And that's really typical. This testimony is typically in mid-February, and there's a Fed meeting at the end of January. So put it this way, I would have been surprised if there was a surprise today. They're in no hurry to cut rates. They think they're well positioned. In depending on how the data comes in, they judge that policy remains somewhat restrictive, and as you mentioned, and your segment mentioned, they aren't inclined to wade into politics or prognostication about tariffs or anything else.
Rich, it feels a little bit unusual right now because it feels like some of the regular sort of Fed critics and wags have been a little quiet as of late. They don't seem to be as concerned here about the Fed potentially making a mistake, right? Do you think that there are any risks from the Fed holding in this pattern where it is right now?
Well, Julie, and good to see you. There's always some risk. I learned that during my 4 years as vice chair. There's always something to worry about. Fed critics had a lot to talk about a couple of years ago, and I was actually encouraged today to hear from the senator, I believe it was Kennedy, who brought up, where we were 2 years ago, 10% inflation, predictions of a deep recession, and what it looks to me and him and like a soft landing. So I think that's also probably relevant. I think it also really reflects a broad support, in Washington across the political aisle for the Fed to maintain its independence in terms of being able to set interest rates and adjust its balance sheet to achieve its goals. But I agree with you. Less criticism than we've heard at some of these hearings.
Rich, on the subject of inflation specifically, Jay Powell saying today to lawmakers, we want to see more progress there. What does the trajectory of inflation look like to you, Rich, over the next 12 months? Are the risks are they to the upside as you see it?
The term the Fed has used, which is a pretty good one, is the bumpy road to disinflation. By the core measure was running near 6% 2 years ago. It's about 2.5% now. So that's a lot of progress, but there's still a ways to go. I do think, however, that there's been a lot of focus on the upside risk to inflation and a lot of focus with sticky inflation. But there is a scenario, perhaps not the most likely, but not impossible, which is that, absent any big sustained increase in tariffs, and so far, it's not clear if tariffs will be a bargaining chip or a battering ram, the progress on disinflation could resume. And so I do think maybe markets and forecasters are maybe underappreciating that we could start getting some positive surprises on inflation, especially as we move out of the winter months. So I'll be looking to see if there's any evidence of that.
Well, speaking of the winter months, as the Wall Street Journal pointed out today, we do tend to see more of a bump in inflation, headline inflation, that is, in the beginning of the year, because as the calendar year turns, you tend to see companies maybe raising prices. So that's what we've seen over the past several years. And even in the pre-pandemic period, if you average it out, you saw inflation sort of higher in the beginning of the year and then waning as the year went on. But is that going to be the case this year with tariffs potentially coming to the fore and other factors that the administration is doing, things like these immigration crackdowns?
Sure. Well, I mean, so far that's not going to, we're going to be getting inflation data tomorrow at 8:30, and so that's not going to be a factor in that data, right, and probably for several more months. And I think your question does, raises an important point, which is a lot of the discussion now is really hypothetical, and any effects that this might have on inflation are really, down the road this year. So, in some ways, we're going to be looking at inflation numbers for the next couple of months that really reflect where the economy was, in several months ago because of the lags.
Would you consider our policy stance here, Rich, restrictive?
Well, the Fed says that in its opening statement, the Fed chair's opening statement made reference to that policy is somewhat restrictive, or perhaps in the monetary policy report. I guess I could agree with somewhat. There are different measures of financial conditions, and obviously stock prices are very, very elevated. We did have a big increase in bond yields, but some of that has reversed. The dollar is strong. So I guess I don't have a problem with the somewhat restrictive description.
Rich, I'm curious to ask you a little bit about the structural changes that are happening in Washington, and some of them at the Federal Reserve itself, as it sort of re-examines some of its climate change criteria that it was looking at before. We've seen a real pushback against diversity, equity, and inclusion, including at places like the Federal Reserve. Do you think that makes the organization stronger or weaker as it undergoes some of that?
I don't have too much to say on that. I would say I do take the chair at his word on the rationale that he offered for withdrawing for this international global network on the green transition. He simply said, look, it's moved in a domain that's beyond the Fed's mandate. So I certainly think that's a sensible approach to take. Beyond that, I'm really not attuned or attentive to what the Fed is doing. I haven't been in the building in several years, and so I don't really have any additional comment.
Fair enough. Rich, good to see you. Thanks for joining us.
Yeah, thank you.
Take care. We're just getting started here on Market Domination. Coming up, shares of Intel rising higher today, but what's driving those gains? We'll get you the details, check in on a few other trending tickers as well on the other side. And after the closing bell today, we've got you covered with the latest earnings results from the likes of DoorDash, Lyft, and a few others. Stick around, much more Market Domination still to come. now time for some of today's trending tickers. Shares of Intel and Global Foundries seeing a pop as Vice President J.D. Vance advocates for the use of American manufactured chips for domestically built AI systems. So it seems like both of them getting a lift from that. Intel shares earlier were up even more. And this despite the fact that although Intel and Global Foundries do make some chips in the U.S., they don't make these types of chips, right? They don't make these types of advanced chips yet, at least, that Vance is talking about.
Yeah, they have been on the receiving end, though, billions of dollars, right, of grants from the U.S. government in efforts to try to jumpstart domestic chip production. I actually checked in with Patrick Moorhead, tech analyst, friend of the show, knows Intel very well, and I was asking him how he would explain this move in Intel today, and Patrick's saying, listen, one, he would pin a lot of this on Vance's comments, and Vance specifically saying Trump administration will ensure that the most powerful AI systems are built in the U.S. with American design and manufactured chips. Patrick also telling me, though, he thinks there's an outside chance an activist investor could be accumulating here. Thought maybe that's another reason you could see the shares popping like we are.
Yeah, I mean, I also emailed a little bit with Jordan Klein over at Mizuho, and he said you also could be seeing a little bit of shorts nervousness in here, so that could be part of it, or maybe momentum buyers coming in as well. So sort of some technical factors in addition to maybe some fundamental hope for the likes of Intel.
Vice President spooking the shorts.
Yeah,
maybe. All right, turning to DuPont, those shares rising. This is the company tops fourth quarter earnings estimates. DuPont also posting an improvement in margins. So the earnings moving high on growth. It sounds like in the electronics market, adjusted EPS does climb about 30% in the fourth quarter from a year earlier. That did beat what the street was looking for. Companies talking about improvements in electronics, among other dynamics, also highlight water and medical packaging markets.
And some of the analysts said it's really kind of a tough environment out there. KeyBank's Alexei Yefremov also saying that. He said impressive earnings results amid a weak operating environment. And so, you know, the company coming out, meeting analyst estimates with some of these numbers was still seen as reassuring and beating, and others even more than reassuring as we see those shares gain today. It's also interesting because DuPont would seem to be exposed to currency effects that we've seen hit other companies. It didn't seem to have that kind of negative effect here.
Yeah, DuPont spinning off its electronics business, going to concentrate on medical devices, biopharma. It sounds like that's split targeted for November 1st.
Gotcha. And then we're looking at Fidelity National Information Services under pressure. Its first quarter and full year outlook disappointing the street. The payment services company also reporting weakness in its banking segment. Those shares down by about 9.8%. Also, the company had been making a small banking acquisition, terminated that, so got dinged with a termination fee as a result of that. So that also looked like it weighed on the numbers.
Yeah, Mizuho weighed in. Mizuho, which actually likes this name, but said there was little to write home about in Q4. Noted that banking adjusted revenue growth slowed to 2% from 3%. Analysts at Bloomberg, who cover this name, highlighting banking revenue miss, lower than expected adjusted EBITDA guidance for both first quarter and full year. Does say capital markets segment growing more steadily, they point out, but shares down today.
Yeah, and the company did announce a $1.2 billion share buyback goal for this year, but didn't seem to help much.
Not today.
At the end of the day, no. Well, stocks mixed ahead of the closing bell as investors assess more tariff policy shifts from President Donald Trump. For more on how to be positioned amid the uncertainty, let's welcome in Leslie Marks, McKenzie Investments Chief Investment Officer of Equities. Leslie, thanks for being here. You know, as you know, it is difficult to figure out what is going to happen, right? We get these tariff announcements. The Canada and Mexico ones were delayed. It looks like the aluminum and steel ones are going into effect. It looks like the China ones are going to go into effect as far as we know. If you are focusing and trying to play all of this, what do you do in the short term? How do you sort of navigate?
Well, thank you, first of all, for having me here this afternoon. And I think you hit on the most important point, which is that the tariff news is creating a bit of uncertainty. It's introducing uncertainty into the market for investors. And so whenever there are things that are sort of unpredictable or uncertain, I think we have to factor that into how we're positioned in our investment portfolios, whether that's through the fixed income side or the equity side. You have to take into account the fact that there is more risk over the investable time horizon than there was before we were talking about tariffs.
Leslie, it does seem like, I mean, listen, there's a lot of hot talk coming out of White House and Washington, but it broadly has felt like, Leslie, investors are kind of willing to look through that. I'm not sure why that is. I mean, maybe that's because, Leslie, they see it as headlines, and to your degree, you're ratcheting up uncertainty, but ultimately they say, listen, the U.S. economy is doing well. I mean, Jay Powell just said that again today before our lawmakers, and maybe that's what they stay focused on. The economy's doing well, labor market looks broadly solid, earnings are growing.
I think that the observation that the U.S. economy is doing well is an accurate one. I think where there's a bit of a flaw in the thinking is the looking through the tariffs. And I think, I've actually thought about this quite a bit. And I think where this comes from is that we've seen a lot of false starts when it comes to tariffs. So there certainly is a strong view that this is a negotiating tactic and that we won't actually see the tariffs that are coming out in these latest announcements, because that's sort of been the experience over the last 3 or 4 weeks. And that was the experience in President Trump's first term. But I think that's flawed logic. And the reason I think that is because I think it's really important to think the connection to, why the tariffs. The tariffs really have two motives. One is to help finance future corporate tax cuts. But the second is really to result in a change of behavior that ends up landing a greater manufacturing economy in the United States. So without actually implementing any tariffs, it's going to be very hard to accomplish both of those goals for the administration. So I think investors do need to start to think that realistically there is going to be some level of tariffs and that should be incorporated into their expectations when they're positioning portfolios.
Leslie, what do you think is most exposed across equities?
Well, I think the manufacturing sector in the short term is probably one that is most exposed in the sense that any company that is relying on imports from other countries as feedstock for their manufacturing operation will be very much exposed in the near term. There's no realistic way over a short period of time that you can reorient your supply chain domestically. And if you just take the tariffs that were announced yesterday on aluminum and steel, for example, we've already heard from the automotive companies about the importance of tariffs to their industry and how devastating that could be. Now, certainly in the long term, if you have, a 3 to 5 year time horizon, yes, we can think about building new aluminum smelters in the United States, but that is not a problem that can be solved in the next 3 to 5 months, 3 to 5 weeks, or 3 to 5 minutes. And so the short term is where we see a lot of uncertainty around supply chains and will have, immediate impact on pricing.
So Leslie, let's say I'm a viewer, I'm listening to this right now, I'm an investor, I say, okay, I want to be in those sectors that are least impacted by tariffs. What would those sectors be, Leslie?
Yeah, so I think I would start in the services sector because the services sector is not really targeted when it comes to tariffs. And so I think investors will do better on the services side. And let's take it back to one of your earlier comments around the strength in the U.S. economy. And even, the global economy is doing pretty well as well. So I think in the services sector, in hospitality, information technology, you could still see those stocks do well. They're really going to benefit from the strong economy that we've seen to date.
Leslie, great to have you on the show today. Thanks for your time. Appreciate it.
Thanks for having me.
Coming up, why is Wall Street shifting its position on cryptocurrencies under the Trump administration? We'll speak with an expert on the other side. Stick around. Much more market domination still to come.
As Bitcoin goes more mainstream under the Trump administration, we're seeing a shift in Wall Street's position on cryptocurrencies to capitalize on a potential boom in the market. For more, we're bringing in Jean-Marie Mognetti, his co-founder and CEO of CoinShares, which is one of the, I guess, older asset managers in the cryptocurrency space. So you've been doing this for a little while. So Jean-Marie, what do you make then of this sort of latest phase? It does seem to be spurred by a loosening in the administration, but it's also spurred a loosening on Wall Street, where they're starting to get more interested.
Yeah, thank you for having me, first of all. And you know, this industry has been built by retail at the very, very beginning. It was the retail investing first, and Wall Street came second when the regulatory framework started to be built up. So the SEC has been very slow to come with something. It's designing something as we speak. So Wall Street is progressively moving into it, and we have this kind of very paradoxical shift right now where we see the retail money being very worried about the tariff. We were just talking about it in the previous segment, and everything which is happening with the earnings on different AI company, and Wall Street, which is like effectively buying the dip on every single pullback on the Bitcoin price. There's a very kind of paradoxical sentiment that we didn't see before in the crypto industry.
Jeremy, there's been some good reports recently about how some of Wall Street's biggest banks are kind of plotting now how to win over more crypto business. The idea being they have, listen, Trump, big fan in the White House, and get ready, here comes a wave of IPOs and share sales. What do you make of that?
Look, Wall Street is not the enemy of its own interest, so the crypto industry has been a very, very flourishing industry since 2012 now. There is plenty of good company preparing for IPO in the US, so obviously they will need to get good support from good banks to do that. You know, I think BitGo, there was an announcement a couple of minutes ago on the news feed about BitGo filing for an IPO or thinking about filing for an IPO, so you see plenty of great company getting into that direction.
Do you see the Wall Street banks more as competition for a CoinShares, or more as a partner, or more as, you know, there's enough demand to sort of go around?
Look, the banks are not competitors to us. What we're doing is very much kind of complementary to what they do. We're offering investment services that they don't offer. We're offering an expertise that they don't always have. So it's kind of working hand in hand and like offering kind of different aspects. You know, like a lot of banks in the gold market offer billion services, but they don't offer they also offer paper services, and they also offer kind of in general investment services. It will be the same thing in crypto. You know, as thematic get wider, they will sophisticate as well, but you know, there's always space for people who were expert very early on.
You all did a survey recently, financial advisors getting their opinions on broadly on digital assets. What were some broad takeaways of that survey? Were there any data points that surprised you in that survey work?
Yeah, this survey was quite interesting because, you know, the idea that people are getting more aware of cryptocurrencies was kind of an obvious outcome of it. What was much more interesting for us is the perception of the crypto industry by the investment advisor, which are struggling to reconcile effectively this massive shift in wealth, which is happening from one generation to another, and which will force them to start looking at things like cryptocurrency because their new kind of investees are looking at cryptocurrency with very sharp eyes, and their lack of capacity to get good education, or what they perceive as unbiased education from cryptocurrencies firm. And that's where CoinShares is trying to effectively step up as the adult in the room and say, look, we understand your problematic, we understand you need unbiased information. We're not just here to tell you it's going to the moon, like the saying says, but we try to give reason and to give a bit more of thinking beyond what we propose. And it's funny because we had an advertising campaign in Germany in Q4, and the advertising campaign was work with the brokerage house, where the brokerage house was saying we need to tell our clients to not invest too much in cryptocurrency. So as a cryptocurrency investment firm, we were making a messaging saying be reasonable, be in the way you invest. You know, the same way a lot of lottery company make advertising saying gamble responsibly, drink responsibly. Well, we were trying to do invest responsibly as well, and don't just like put all your eggs in one basket and diversify.
And is that, do you diversify within the cryptocurrencies as well? I'm curious where you're allocated right now at CoinShares.
No, you can diversify outside of cryptocurrency. You know, there's a lot of researches which has proved that having a little bit of cryptocurrencies in your, especially Bitcoin, in your investment portfolio goes a long way in terms of improving the risk-return parameters of your portfolio and its volatility-adjusted return as well. So it is a good thing to have as a diversification methodology. If you look at a risk premium portfolio, it has a lot of value as well. So there's plenty of things you can do. And, you know, yes,
we've been doing single coin ETF effectively in Europe for 10 years, but the future isn't really in that direction. We're not going to do in the US what we've been doing for 10 years in Europe. So the real future is like how you start mixing cryptocurrencies with traditional assets and bring better risk-adjusted products to the market.
John, I'm just curious. In that survey work you did, was there any kind of, did you pick up any kind of meaningful generational differences among advisors? Did younger advisors, did they seem to think differently about digital assets and maybe their relatively older colleagues and peers?
It's a good question you're asking, because effectively what we're seeing is like the peer pressure among financial advisors is very strong. And like they're very, very wary of what the older colleagues are going to think about them. So the younger generation pushing up is still very much looking at, okay, how is my boss going to look at me for doing that? We used to say in traditional cryptocurrency world that it used to be a risk for your career to invest in cryptocurrency, and now it's becoming a risk for your career not to do it. But when it comes to financial advisors, it's still perceived as a risk because the older generation of risk advisor are still not embracing it completely. And you can see this dichotomy the same way at the family table, when the dad or the mother or whoever is like running the portfolio of the family, which is the older generation, is being told by the kid or the daughter or the son, why don't you have Bitcoin in your portfolio? And then the Thanksgiving debate dinner table is transposing at the investment advisor kind of investment committee, where you get this generation kind of having a bit of friction together. It will take time, it will solve, and we want to position CoinShare, have this kind of tool for them to be able to help resolve that kind of narrative, I would say, breakout.
Jean-Marie, thanks for coming in. Appreciate it.
Thank you very much.
Good to see you. Let's get to some calls of the day right now. First up, we've got IBM. Oppenheimer initiating coverage of the company with an outperform rating and a $320 price target, citing the company's transformation into a software-driven business with strong growth potential. The firm expects IBM to sustain double-digit revenue growth in its software segment, fueled by its Red Hat offerings. And Oppenheimer adding in its note that IBM's growing role in AI through its Watson X platform and AI-focused offerings provides additional upside. The shares up today, they are trading a little, they reached a record high on February 4th, and they're trading down a little bit from that level.
So this analyst telling his clients, not your father's IBM, Julie. Our differentiated view, he says, is based on IBM's successful pivot to a software-centric company and to expect revenue and margin trajectory higher than consensus. By the way, CEO Arvind Krishna, IBM CEO, was speaking during an interview with Bloomberg, talking DeepSeek, saying this DeepSeek moment will help fuel AI adoption, saying we'll find that the usage will explode as costs come down. He went on to say, I think it is validation. We have been on the point that you do not have to spend so much money to get these models.
Interesting. That seems to be kind of what people are coalescing around, that view.
The narrative. Our next call of the day. Check out Peloton. Those shares in a nice boost. It's after Argus upgraded the stock to buy from hold. Price target set at 15. Talks about demand, Julie, for in-home health subscription services under new CEO Peter Stern. Analysts saying, given his background in the health and fitness industry, we think that Peloton's new CEO can reduce debt, revive subscriber growth, and increase customer retention. Yeah, they seem to like the recent earnings report that Peloton came out with here. And so part of this seems to be a follow on that and on the hopes being put on Peter Stern there. Over the longer term, as the analyst points out, we expect Peloton to benefit from increased interest in fitness products and operating leverage on higher sales. The margin story, an important part of their thesis on Peloton as well. Yep, keep watching. Meanwhile, shares of Tesla, they are sliding today. They are now down over 19% year to date. For more on the EV maker, let's welcome in Colin Rush, Oppenheimer Managing Director and Senior Research Analyst. Colin, it is good to see you. Let's start right there with the action we've seen in the stock. Down almost 20% now year to date. What explains that slide, Colin?
Yeah, there was a big rally in shares after the election, and there was a bit of a disconnect in our view between what's happening fundamentally and what was happening from a sentiment perspective. Certainly, the company has done a nice job of pivoting from just being a durable goods manufacturer and a vehicle manufacturer into physical AI, and that's something that we see as having long-term growth trends. The challenge, though, from our perspective, is what's happening with its legacy business. And we've seen cost reduction happen before in other industries like solar, LEDs, and batteries. and we're cautious on what's happening for the EV makers in China from a margin perspective. And so this morning we're trimming numbers a little bit here on price pressure in China, as well as some potential backlash around some of Elon's extracurricular activities outside of Tesla.
And boy, his extracurricular activities are climbing every single day, Colin. Now, as you know, he has long been a multitasker. He heads a number of different businesses. He's involved now with Doge. Yesterday, we learned that he was leading a group bidding for the nonprofit entity that controls OpenAI. That seemed to be a tipping point for you, perhaps, that last item. After he's done all this other stuff, what is it about that particular headline?
It actually wasn't. We had the trim on the numbers ready to go, and so I actually had to adjust some of our writing after that news hit yesterday. We were ready to go prior to that, and for me that's just endemic of his interests. Like, he's got a wide mind and a deep skill set and a deep curiosity around the world and how it works. And I think there's an awful lot at stake with who owns and manages a lot of this AI IP, and so. From my perspective, we were really just worried on the fundamental basis, and in the OpenAI considerations, really, I don't think are really relevant to the stock just here. I think the bigger news today was more about BYD, a Chinese automaker, introducing some of its own self-driving technology, and that's something that Tesla has not gotten approved for in China at this point. And so it looks to us like the competitive environment is intensifying in China, and I think that's a bigger driver of what's going on with the stock today.
Let me ask you, Colin, I've also seen some make the case that they think Tesla is in some sense getting penalized here for Musk's allegiance to President Trump. Do you think that's also another variable at play?
It's he's gotten a lot of credit for being aligned with the regulatory authorities at this point over the last number of months. I think as we look at valuation and the company trading north of $1 trillion of market cap, there's a lot of anticipation around the potential value creation for the platform. And, over the next couple of years, we see it being a little bit challenged. We think numbers are too high on the street. We're near street low for both this year and next year on vehicle deliveries. And I think that's a bigger issue for the stock here to really work. Should, Tesla not deliver on a number of promises that they're making around both autonomous vehicles and the humanoid robots.
Well, I think, Colin, some of the assumption by some on the street who continue to be fans of the stock is that, Musk being so close with Trump will help his business endeavors, could help him get FSD approval. But I guess what you're saying is, if FSD tech isn't ready, the approval is sort of irrelevant.
Yeah, and I think that's a fair point. And also, political winds shift pretty quickly. There's an election in Germany in a couple of weeks. We're watching that pretty closely. Elon's gotten involved in that. And one of our concerns is around European consumers not buying Tesla vehicles because of political reasons. There's a lot of other options on the market, and we see that as a potential risk for sales this year.
Colin, after this slide, final question here. I'm just curious, what does valuation look like for this one?
It's hard to peg it. Certainly there's a lot to figure out here. From a autonomy perspective, there's a couple of ways to look at the opportunity in terms of vehicle miles traveled and monetizing those. And so we can see our way to $1 trillion type valuations. I think what we want is some evidence that the company's really making real traction in that direction. And so far, what we're seeing is numbers continue to drive get softer and softer here over the last couple of years, and we want to see a little bit more meat on the bone from the company.
And sort of on a related note, Colin, am I reading correctly that you don't have a price target in your note on Tesla?
That's correct. We don't have price targets for perform-rated stocks, and that's something that we don't have to publish, and so we're not at this point.
Gotcha. Colin, thank you so much for your perspective. Appreciate it. Coming up, we're joined by an analyst to tell you the best ways to be positioned in the beverage industry in today's investor playbook. Stick around, much more market domination still to come. a lot to worry about when you're commander-in-chief, but Yahoo Finance senior columnist Rick Newman highlights 3 specific concerns for President Donald Trump, and he's joining us now to talk to us about them. So, Rick, what is Trump worried about right now, or what should he be?
Hey, guys. Well, I don't know if Trump's worried about it, but I think a lot of people who are affected by Trump's policies are getting somewhat worried. So one that caught my eye this morning, the monthly survey done by the National Federation of Independent Businesses, that's a small business confidence survey, basically. It dropped from December to January by more than people expected, and there were a number of signs in there that people who run businesses they've been hearing a lot about Trump's tariffs and they don't like them. So there are concerns about the future of the economy, that the outlook has dimmed there. There are concerns about spending money, so these businesses seem to be cutting back on their spending plans for the next 12 months. If we compare this to some surveys of consumers, we see similar things. They are worried about prices going up. Trump's approval ratings on handling of the economy, trade, and taxes have all fallen in just 3 weeks. That's according to Morning Consult. And we see in the University of Michigan survey that comes out every month, people think inflation is going to get a lot worse. So, this doesn't mean that the doom and gloom abounds throughout the country, but it does show that people are hearing, for sure, they are hearing a lot about Trump's tariffs. They think they're going to raise prices and perhaps have other adverse consequences, which economists say is likely to happen, and they're getting worried. So, as a reminder, the thing that voters cared most about in 2024, it wasn't tariffs and trade. It was prices. It was prices and inflation. And we have eggs going up now. At my store, eggs are $11 a dozen, and that is not whole paycheck. That's just a regular grocery store. And Trump is not talking about food prices. He's talking about trade and punishing people and stuff. So I think he's getting a little off message.
Having said that, Rick, that CBS poll I thought was pretty interesting. That recent one showed Trump's approval rating 53%. I think that's the highest he's ever enjoyed. What do you think explains that?
Yeah, and that's the highest of polls that are out there. There are other ones that have him around 48, 49%. I think the aggregate is about 48%. He is enjoying something of a honeymoon, which most presidents honestly get. I mean, Trump was kind of an outlier when he came into office the first time in 2017. He was not as popular as other presidents. But I keep seeing headlines when I'm looking at Wall Street analysts or economists, and the headlines are Trump's honeymoon is ending or the Trump honeymoon is over. David Rosenberg at Rosenberg Research, he's an economist. He wrote that today, looking at those small business survey results. Just every president's honeymoon ends at some point. Trump's may be ending within his first month, which will probably be faster than other presidents. But we'll see if maybe he gets the message and he does something to turn it around.
Thanks, Rick. Appreciate it.
See you guys.
Coca-Cola stock is having its best day in more than 2 years after fourth quarter revenue beat by a wide margin as sales volume returned to growth. The company brushed off concerns about how tariffs announced by the Trump administration might affect costs and change business plans, but plenty of other beverage companies are facing similar challenges. Joining us now to help us navigate the beverage sector is Nick Modi, RBC Capital Markets Managing Director. Nick, it's good to see you. I guess I would ask first, how Coke seems to be navigating that better right now, at least as reflected in its latest numbers, or is that your assessment?
Yeah, I mean, look, fundamentally, they have had some pretty good momentum going back, 6-7 years, right? And I think part of the issue is that competitively, they are really gaining traction and taking a lot of share from Pepsi and some of their other competitors. And so Coke's strategy is, I've been covering the stock for almost 20 years. I've never seen their fundamentals in this good a shape. Their marketing, their productivity initiatives, their innovation. And so they're in a really, really good spot as it relates to dealing with a lot of these headwinds that a lot of companies are facing right now.
Nick, I have to ask you about these aluminum tariff threats we're hearing from the White House. I'm just curious how that ripples through your coverage universe. Nick, are there certain names that would be more exposed than others there?
Yeah, I mean, look, Coke obviously is impacted, but they've done such a good job of maneuvering their packaging mix so they can move to more PET away from aluminum to kind of cover themselves or protect themselves. But other companies like Monster Beverages and Monster Energy, which is one company that I really like, they'll obviously be affected. I think they have some pricing latitude to help offset some of those costs. Another name we like is Primo. Waters, and they deal with a lot of plastic, so they're actually much more hedged than the other beverage companies. So, it's a real mixed bag in the beverage space as it relates to aluminum tariffs.
And then in addition to the aluminum tariffs, I would think that for some of these companies, the strengthening dollar is also a bit of a problem, a bit of a headwind. So talk us through that and how the different companies are sort of dealing with it.
Yeah, I mean, look, even though we love Coke's fundamentals, one of the reasons why we didn't make it one of our top ideas coming into the year was because of this FX and currency issue. Yes, the stock's doing really well today based on its great performance, but I think the upside is going to be limited as long as the dollar continues to appreciate, because that has a very big impact on Coca-Cola. So that's why we like Primo. Primo is actually our top pick, and it's primarily because it's a very U.S.-centric company with very low exposure to a lot of the Trump 2.0 policies, right? And they just merged with one of their biggest competitors, and we're going to get a lot of updates from them over the next week or two. But we really like that story for 2025.
Nick, another theme I'm just curious to get your take on, GLP-1s. How does that ripple through your coverage universe, Nick?
Yeah, Josh, it's an interesting thing. I think a lot of the studies that have been done on suggesting the impact GLP-1 has had, it really was at the same time where consumers were feeling the bite from inflation. So it's really hard to separate the structural and cyclical in terms of how GLP-1s have actually impacted consumption. The way we look at it is these categories tend to over-index to lower income consumers. That's why inflation plays such a role. And GLP-1 consumers are not necessarily in those low income cohorts. The other thing I would say about GLP-1s is that the retention rate on the drugs is not very high. And so you get a lot of churn, right? And so people might get on the drug, lose their 25 pounds, maybe curtail their consumption. And then when they come off the drugs after they lose their weight, they gain all their weight back and they may not get back on. So it's kind of an interesting dynamic. Look, don't get me wrong. I believe that this is certainly a marginal risk. I just think that it's been made a larger risk than it actually is as I look at my coverage.
And Nick, you mentioned that Coke wasn't one of your top picks coming into the year, so I do want to talk about some of your top picks. And I want to talk about Constellation Brands, because that's such an interesting one, really in the crosshairs of not just aluminum, but tariffs from Mexico would be a big issue for Constellation. So why do you like that one?
Yeah, actually, it wasn't one of our names coming into the year for that very reason. And then it sold off after they reported earnings and some of the tariff news. And we said, listen, the stock market is a discounting mechanism, right? And so at some point, you have to look at the math and say, this stock is already pricing in the risk that may or may not happen, right? So if it doesn't happen, and of course, we saw the delay in the tariffs for Mexico and Canada, so maybe they don't happen at all. If they don't happen in the next month, then this stock is going to rally just because I think the stock is already pricing in the earnings risk associated with a tariff. So, at the end of the day, we like the fundamentals. We think that this kind of Trump 2.0 risk is already in the stock. And if it doesn't happen, then we're going to see some upside.
Nick, another name, Monster Beverage. It's down about 14% here over the past 12 months. Is that a buy, Nick?
Yeah, it is. We like the stock on the pullback. We think they're really set up well for 2025. We think they're making a lot of interesting changes as relates to their dealings with the Coca-Cola system, which is their biggest distributor, as well as some of their expanded channel strategy. This is a company that was very, very focused on convenience stores and now is starting to broaden out its focus and its efforts. And so I think they're set up for a very good year. And also we have some easy comps coming in the back half as well, which I think will kind of aid the optics of their growth story.
Nick, always great to see you. Thanks for your time and those picks. Appreciate it.
You bet. Thank you.
While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings from DoorDash, Lyft, and many more. Stay tuned for Market Domination Overtime.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern. That's the closing bell on Wall Street, and now it is market domination overtime. We're going to be joined by Jared Plickry in a moment to get you up to speed on the action from today's session. Let's start with the major averages here, where we saw a mixed picture. The Dow gaining 129 points, about 0.25%. The S&P, very little change when all was said and done, and the Nasdaq down about 0.4%. Investors still sifting through tariff headlines, as well as testimony from Fed Chair Jay Powell today, in which he seemed to basically say the Fed is staying the course and is in no rush to change interest rates, to presumably cut interest rates. The Fed is in no rush to do so. We saw a mixed picture when it came to large cap tech as well. But overall, yields up a little bit today as we heard him speak, and stocks kind of seeing this muddle, if you will, on the session. CPI coming tomorrow morning, so we'll see if that makes more of a dent one way or the other. Now let's go over to Jared for a closer look at today's action.
Yes, we have something called FOMC drift, that's Fed drift, right before Fed days. We might have gotten a little bit of that today before CPI with Powell in front of Congress. Maybe that's all a stretch now, but major indices not doing a whole lot. I'm just going to show a 3-month chart of the Nasdaq here, and I want to show that it's really just consolidating in this giant base. So is the S&P 500, looking for that next catalyst. Is it going to be CPI? Well, very well could be. We just have to wait and see. So here's how the sector action panned out today, and let's put that on sectors. There we go. Everything but consumer discretionary, which was down over 1%, and healthcare, which is actually on a 4-day slide, was in the green. Consumer staples leading the rebound there. I believe some action in Coca-Cola, up 4.74% on some earnings there is one of the major catalysts. We're also seeing Apple up 2.18% today. Apple kind of bucking the trend of the negative mega cap action that we're seeing a lot of these names here. Tesla down 6%, Palantir down 3.5%. Yes, I threw Palantir in there as well. Meta now going, is this 16 or 17? I have lost count, but Meta extends its streak today. It's up 17% over the last month. This year it's up 23%, and I believe that is good for 17 days, but don't quote me there. Just taking a look at some of the leaders, and then we'll head out here. KRE is in the upper left. That is regional banks. So regional banks did well. Guess what? Solar did the worst today. And I'll send it back to you on that, Josh.
Jared, thank you. Stocks losing a bit of steam heading into the close on Wall Street. Fed Chair Jerome Powell testifying on Capitol Hill, saying the central bank in no hurry to cut rates. But now investors shifting their focus to inflation data ahead of the open. And our next guest says it's all about core CPI. Joining us now is Christina Hooper, Invesco Chief Global Market Strategist. Christina, good to see you here on set.
Great to see you.
So I actually do want to get your take quickly on the news of the day, which was Fed Chair Jerome Powell. He was talking to lawmakers, and the takeaway there, the message, it was really simple, Christina. It was, listen, we are in no rush to adjust interest rates. Economy's doing well, right? We'd like to see a bit more progress on inflation. What did you take from that testimony there? What did you make of it?
I think it was very much a repeat of what we heard in the last FOMC press conference. It was all about patience. We're going to be very careful about our next move. And quite frankly, we're happy with where we are.
And do you think that that happiness is justified? You know, we're going to get a CPI print tomorrow morning. Do you think that we are going to continue to see this disinflationary trend?
I think we are going to continue to see it, but it could be imperfect and a little ugly. I don't think it's going to be, a natural improvement in disinflation every single month. And so we could get some surprises, some ugly components, and we just have to watch for that. I think what the Fed is going to do is take some time and wait to assess trends. I don't think it's going to make any moves. I think the earliest it would cut again is probably the end of the second quarter.
Yeah, because I'm sure, Christina, a lot of viewers are probably watching right now. They're saying if inflation's still above target and the labor market is showing you signs that it's, appears to have stabilized, why would the Fed cut?
Well, because as Jay Powell admitted at the FOMC press conference and admits at multiple occasions, is that monetary policy is restrictive. If we look at where we are today in terms of inflation versus where the Fed funds rate, and if we were to actually add in quantitative tightening, other monetary policy tools, what we get is an even more restrictive monetary policy. So as long as you're confident that disinflation is going to continue, then it would actually be a reason to continue to cut. But given where we are, I think the Fed is being thoughtful, careful, prudent, and saying, let's assess the data, let's hit the pause button.
Right. So what does all of this mean for U.S. stocks, right? Because I know U.S. stocks are not actually your preferred trade right now, or in terms of your preferred weightings and allocations. Why not?
Well, it means that U.S. stocks are going to have to stand on their earnings. And earnings season has been quite good, and I think the outlook is quite good, but U.S. stocks are expensive when we look at the overall index. Now, there are many parts of the stock market that are far more attractively valued, but in general, what we have is stocks that are seeing earnings catch up to where they are in terms of prices. And so there are opportunities outside the U.S. Now, the economies don't look nearly as good. As we've heard from Jay Powell, he wouldn't want to trade places with other countries. So the United States is in a very good place. But you don't need a great economy for a stock market to perform well. What you need is positive surprise, some kind of catalyst. And what we likely have in terms of catalysts in both the UK and Europe is slightly improving growth picture, and of course, the potential for significant rate cuts this year, which we know we don't have in the U.S.
You mentioned Europe, UK. What about Japan, Christina?
So I think there's certainly a lot of potential in Japan as well. What we're seeing is improved wage growth, an economy that is structurally improving after years and years of stagnation. So I think there's a lot of potential there. Japanese stocks valuations on a relative basis are a bit higher than Europe and UK, but still lower than the US. There's opportunity there, but keep in mind the Bank of Japan is actually hiking. Now that's a normalization. That should be a vote of confidence in terms of the economy, but it means to me that we're likely to see better performance from UK equities and European equities.
European equities in particular, of those that you've named, would seem to be at the highest risk of tariffs from the United States, as the U.S. is, as we are its biggest trading partner. So how do you think about that potential risk?
Oh, I think that's a significant risk, but we know that there's a risk in a lot of other markets that tariffs could impact them. And so I think we have to operate with that understanding, which is why at the end of the day, it's so important to be well diversified.
Christina, good to see you. Thank you so much.
Thank you.
Got to get to some earnings now. We've got DoorDash fourth quarter numbers now just crossing the wire. DoorDash coming out with earnings per share that actually missed by a penny a share, 33 cents versus the 34 cents that analysts had been anticipating. It looks like EBITDA did beat estimates, as did fourth quarter revenue. And then looking at the company's first quarter forecast here, the company says first quarter adjusted EBITDA will be $550 to $600 million. Analysts had been looking for $585 million, kind of the midpoint there. But it looks like what is also, one would think it would be better news for the shares. First quarter gross order value going to be $22.6 to $23 billion. That whole range is above the $22.4 billion that analysts had been anticipating. So interesting that we're seeing the shares fall in reaction to this.
This one had been a rock star too, though. I mean, it was up about
Good point.
60% over the past year. I know financial analysts who cover the name, I know they're going to be looking for more color and commentary, Julie, about U.S. restaurant growth, the trajectory of DashPass membership, advertising growth. Some bulls also looking for potential near-term catalysts, and they always do mention, S&P 500 possible inclusion there as one to watch.
Right. Well, no news on that front
Nope,
today,
we're
but
down
I'm just looking through some of the other financial metrics here for the fourth quarter. Total orders up 19%, and the company's gross order value up 21% to $21 billion or so. Revenue was up by 25%. We already talked about some of the profitability numbers here. So, we'll see how the stock settles out here as people go through the numbers, and also, sort of compare them to the likes of Uber Eats, for example, as well. So, as you said, the stock has been doing well, so that's something else to keep in mind with the backdrop.
All right, let's move on to another name and moving here in the after hours. Shares of Lyft, fourth quarter results just hitting the wire now. We're down to Swift about 6% immediately. Lyft Q4 adjusted EBITDA 112.8 million. Street was closer to 104.4 million. Q4 revenue 1.55 billion. The Street was at 1.56 billion. Q4 active riders 24.7 million. Estimate was 24.63 million. Just looking ahead now, Q1 gross bookings, they're calling for about 4.05 to 4.2 billion. Street was closer to 4.23 billion. They do announce, it looks like, some capital return news, Julie. Announced their first buyback program, but stock immediately under some pressure here.
Yeah, the buyback program going to be up to $500 million worth of shares. And again, as you said, it's their first program here. David Risher, the CEO, talking about this being a record year for the company. And he said, our biggest competition is inertia. So he is definitely sounding an optimistic note here. CFO Aaron Brewer talking again about the records, gross bookings, margin expansion. first full year of GAAP profitability, record cash flow generation. So really, they're trying to put a more positive spin here on these numbers, as they also, again, talk about that repurchase program that they are initiating now.
Yeah, and the first quarter adjusted EBITDA, I think this explains some of it. They're calling for between 90 to 95 million. Street is closer to 93.7 million. And so I think that explains we're down to more than 7%.
Yeah, we're going to get more color on this, by the way, because we will be talking to Lyft CEO David Risher on Wednesday to react to these numbers. So we will figure out what's going on here. We'll see where the shares settle out before then.
All right, coming up, we are checking in on the latest earnings results from Upstart Holdings as those shares are jumping. Stick around, more market domination overtime coming right up.
Upstart Holdings, the fintech company that does lending, out with its fourth quarter earnings. Shares up 20% here. The company posting an unexpected earnings per share of 26 cents on an adjusted basis. Analysts had been predicting a loss, and revenue of $219 million. That is a 56% gain year over year. The company's also giving a forecast here. First quarter revenue, it says, will be about $200 million. That's above estimates. And adjusted EBITDA in the first quarter should be $27 million. Around $7 million is what analysts have been anticipating. The company's also predicting full year revenue of $1 billion. $816.8 million is what analysts had been anticipating. And indeed, the CEO in the statement talking about the business growing dramatically in its fourth quarter, and they came within a whisker of returning to profitability on a GAAP basis, Josh?
Yeah, this is the AI lending platforms. They apply AI to consumer lending. They help banks originate loans. The executive sounding very positive here. CEO saying we launched in 2025 with unparalleled energy and optimism for the future of upstart AI lending and the mission we're on together. So he's sounding confident. And look at that move in the after hours, 22% right here.
You probably know what I'm going to say. I just quickly looked up that short interest, and it's above 20% afloat. So, yes, these are good results. It looks like on the face of it, there's probably also a short squeeze
Potential
going
squeeze,
on.
you're saying.
Potentially, could be. All right, Lyft shares are sliding as the company's fourth quarter gross bookings fall below expectations. The rideshare giant also announcing its first buyback program. With a closer look at the quarter, we've got Roth MKM Managing Director Rohit Kulkarni. Good to see you, Rohit. So just give us your sort of big picture view on the quarter and what we just heard from Lyft.
I think the big negative surprise here is bookings. Bookings came in slightly below expectations in 4Q. 1Q guidance on bookings is also slightly below expectations. And that's the top line that drives the value here. On the other hand, we had Uber and mobility business that is at a much larger scale and has been growing faster. So there is almost a tale of two cities developing again, which over some part of 24, we had that narrowing between the growth rate of Lyft and Uber. But unfortunately, what we are seeing in 4Q and 1Q and just their overall commentary around mid-teens growth, whereas Uber is talking about very high teens, maybe 20% growth. So the gap between growth is widening, which is worrisome for Lyft.
So what do you think, this sort of muted, first quarter bookings, profit outlook? Any estimates, Rohit, of what you think explains this, the puts and takes here?
So there is a slight thing they talk about pricing. I think there are from a demand perspective, I think the demand for rides in mobility is as strong as ever, which means the volume should do well for both Uber and Lyft. But I think on the margin, Lyft tends to always be a price taker, and probably at that is what is developing from a hypothesis standpoint that pricing isn't as conducive for Lyft as compared to what Uber can or sometimes will dictate price.
So it's interesting here, Rohit. The company has also introduced some of these price incentives for returning customers, right? Their price lock that they've been doing. They've been trying to really get in commuters to use Lyft. How successful do you think that program has been?
I think the product portfolio of Lyft today versus what it was maybe 9, perhaps 12 months ago is significantly better with regards to innovating in the mobility side around new products that you just mentioned, Julie. They have a price lock feature. They have a recurring rides feature. They have slightly nuanced features as compared to what Uber has maintained their core feature set. So I think they have innovated on the product, but perhaps there is a pricing kind of discount that they are ending up having to take as compared to what we saw last year. Also, this is at the end of the day a marketplace with a demand-supply balance that Lyft and Uber have to strike. Right now, perhaps there is oversupply at Lyft, which kind of tends to have an indirect impact on price.
Rohit, CEO David Risher, he's been CEO there for nearly 2 years. I'm just curious, you're a financial analyst and you know the stock, you know the story. What do you make of the job he's done?
I would give him 3.5 stars. As in, I think overall the progress that Lyft has had from a product perspective, from a financial perspective, from a financial performance perspective, I think the progress has been tremendous. Whether it manifests into the stock remains to be seen, simply because for a company of the size and scale of Lyft, we need not just 1, but 2 or 3 quarters of baby steps of improvement. And unfortunately, in the last 4 to 5 quarters, we haven't seen that consistent 3 quarters of consistent execution that one would want for the stock to have that escape velocity. I would still give them credit that they have executed. Execution has improved, but we just want a little bit of extra consistent execution.
Rohit, I want to switch gears and ask you about DoorDash as well. This is another stock that I believe is falling in the after hours following its numbers. It looks like its outlook that was disappointing for folks, in particular, perhaps its EBITDA outlook here, although actually I stand corrected. Now the shares have turned around. Now it's quickly things change, Rohit. What did you think of those DoorDash numbers?
I think, DoorDash is executing as well as one can. They had a fantastic 24. I think they're kicking off 25 with the positive momentum, in my opinion. The bookings again came above expectations. When it comes to investment in the business, investing upside into the business, DoorDash is doing exactly that. So that's probably the slight perceived disappointment in EBITDA guide for the near term. But that's exactly what you would expect a company that's a market share leader, growth leader, and has been executing very well to do. That is invest surplus profits into the business and just control the EBITDA upside, the profitable upside that they have. So from a stock call perspective, the gap between Uber and DoorDash from a multiple standpoint is the widest we have seen. So the bar was slightly higher for DoorDash. Why isn't the stock up 5 or 10%? That's exactly why. It's a premium stock, trading at a premium valuation, so they needed a premium result. And this is I would just say slightly positive result and not a 5-star premium result.
So Rohit, I know you're neutral on DoorDash. Is the primary reason is a valuation call there?
Essentially a valuation call, and the belief that this company probably won't let profitability flow through as bullish investors expect them to. So that's why the valuation feels stretched and will remain stretched. Just to give you context, Uber, despite the last 20% move, is trading at 16, 17 times EBITDA. DoorDash is trading close to 28, 29 times EBITDA. This is the widest we have seen, and the growth rate between these two companies is not very, very different. So in such cases, we always prefer the cheaper stock, which is Uber.
Rohit, always great to see you get that instant reaction. Appreciate it, my friend.
Thanks, Josh. Thanks, Julie.
All right, Supermicro Computer updating its second quarter guidance. Now saying it sees adjusted earnings per share coming in between 58 and 60 cents. So look at the stock there, about 0.7% we're higher. Let's get to the numbers, Julie. So Q2 adjusted EPS, 58 to 60. They had seen 56 to 65. The street was looking for 64. The top line, they're saying Q2 net sales are calling for between 5.6 billion to 5.7 billion. They had seen between 5.5 and 6.1. And then looking out full year net sales, they're calling for between 23.5 to 25 billion. They had seen 26 to 30 billion, and the street now we're up nearly 1% here in the after hours.
Yeah, but to put that in perspective, the stock did a quick drop of something like 19%. After the headline started crossing on this, before this little bit of a turn positive. And as we know, Supermicro has been sort of a controversial stock. It's been quite a volatile stock. It first soared on last year on this outlook that it would be one of the beneficiaries of AI, but then came down pretty sharply. There were questions about its accounting. So that's why we're getting this, business update that is not a full earnings report, that is, and we've been waiting for sort of the complete financials from this company for a little while here.
It's a remarkable story because at one point, it was seen as a true AI darling. I mean, this stock was at 123. That was the all-time high here. But as you know, then we had just a very turbulent year. Remember, in December, they were, talking about they would replace their legal and financial leadership. There was the former.
They had to get an auditor, a new auditor.
Employee alleges attempts to overstate revenue. But then you did have some recent news when they said, they were ready to ship these new AI data center systems with NVIDIA's latest and greatest chips that got themselves a pop. So to your point, it's been a roller coaster.
It has. So we'll see where that roller coaster ends up
we shall.
Tomorrow. We might not stay up. We'll see. We'll see what happens.
Time now for What to Watch Wednesday. That's February 12th. Starting off on the earnings front, another round of earnings coming in tomorrow. That includes CVS, Dominion, and Reddit. Now, Reddit is announcing results for the fourth quarter after closing bell. Expectations are high for the social media company, with analysts projecting high top-line growth from LLM traffic in Q4. 4.
And taking a look at the economy, we'll be getting a key piece of inflation data with CPI, the Consumer Price Index. Economists forecast total CPI will slow to 0.3%, and core CPI will tick up 0.3% on a month-over-month basis. January's inflation report will provide important data for the year ahead, as it typically reflects significant price adjustments made by businesses to start the year.
And moving over to the Fed, another round of Fed commentary coming our way throughout the day. That includes Fed Chair Jerome Powell's second day of congressional testimony. Powell testifying before the House Financial Services Committee in the morning. This is coming after Powell went in front of the Senate Banking Committee today, urging patience with future interest rate cuts.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. It was a mixed day for markets as Fed Chair Jerome Powell testified in front of Congress and urged caution on rate cuts. We're going to dive into the rest of today's market trends. Then Apple and Alibaba are teaming up in China. We'll explore the partnership and what it could mean for the rest of the smartphone market. Plus, a multi-billion-dollar deal in the hotel sector with Hyatt set to expand in the Caribbean and Mexico through an acquisition of Playa Hotels. We're going to break down that deal. Well, Apple is expected to unveil a new iPhone SE. This would contribute to a pivotal time for the tech giant smartphone business as it continues to work on its AI strategy. Apple reportedly partnering with Alibaba to bring AI features for iPhones in China, according to the information. Here with more on the key moving pieces of growth for Apple, we have Technalysis Research President and Chief Analyst. That's Bob O'Donnell. Bob, always great to see you and have you on the show. Let's start with the hardware, Bob, because this new revamped iPhone SE, Bob. We have reports saying this device is coming really any day now. If and when it does, Bob, what would you expect demand to be like for a device like that? What would you expect the contribution to be to the overall iPhone franchise?
Well, look, Josh, first of all, thanks for having me. The SE has never been a huge part of the iPhone market in terms of a percentage, but there's a very distinct group of people who just don't really like huge phones. And the SE has served that market. I happen to know one because my wife has been like that. She's never liked the big phones. She always wants the smaller SE type phones. And there's plenty of other people like her. And so the SE is generally way out of date when it comes to the technology in terms of the processor or the camera. So all the rumors point to basically an SE that has the capabilities of the latest iPhones, but again, in that tiny small form factor and at a significantly lower price. So, and of course, it'll add USB-C, and Apple has to do that for Europe because you have to have USB-C there now. And a lot of people are getting used to USB-C connectors for power adapters and everything else. So Apple checks off a whole bunch of boxes with this SE. Again, I don't think it has a huge impact in terms of the total sales, but it definitely fills an important niche in the product lineup.
Do you think, Bob, there would be certain markets, certain regions where you would expect such a device to be more popular than others? For example, do you think it could prove a winner in the emerging markets?
Absolutely. I mean, this is a sub $500 in the U.S. iPhone, new, right? And in a lot of those emerging markets, the only way you can get an iPhone close to that is the used market. Of course, there is a relatively robust used market in some of these emerging markets. But yes, the SE clearly is targeted towards some of those emerging markets as well. And those are obviously very important to Apple. So yes, I think we'll continue to see it. Again, this would be the fourth generation of the SE. So it's not like it's a brand new category or segment there. It's something that's existed. And I would imagine it, you could look historically at what the SE has done. People have modeled those out. And it's going to be probably relatively similar. Again, adds a lot of the nice new capabilities. They'll give it a bump for sure initially because of that. And then it'll kind of fit into the overall pattern of the iPhone.
Well, let's switch from hardware to software, Bob, because the other news with Apple was this big headline from the information saying that Apple is planning to partner with Alibaba to bring AI features to Apple products in China. Interested to get your take on that news, Bob.
Yeah, well, I mean, look, this is something that we knew had to be coming, not necessarily with Alibaba, but in order for Apple to bring Apple Intelligence to China, they were going to have to find a Chinese partner. And it's well known that Chinese consumers are very interested in AI capabilities. So there's a lot of pent-up interest in the iPhone 16 and its AI capabilities. But of course, we saw, there are people saying, hey, look at these China numbers were not great for iPhone. So there's concern that it's slipping there. Now, some of that is due to geopolitical tensions and a focus more on domestic brands in China. But another big part of it is, in fact, the fact that we haven't had Apple Intelligence in China. So there was never a question of if, Apple was going to do it. It was only a question of exactly when and with whom. And so this news suggests it's going to be with Alibaba, who's, they're one of the biggest AI players in China. They're obviously a big household name in China. So it brings together Apple and this important Chinese domestic brand, gets Apple past, the government requirements, which is to work with a Chinese company. So it seems very much like a smart move. Having said that, I also wouldn't be surprised if we see in China Apple doing the same thing they said they would do here in the US. So they announced, for example, AI features with OpenAI here in the US, but then quickly said, but don't forget, we're going to potentially work with others. And they mentioned Google's Gemini, for example. We could see, in fact, that Alibaba is joined by Baidu, who was originally rumored to be working with Apple, and maybe even DeepSeek, right? I mean, so DeepSeek, it's gotten a lot of attention lately, both here and in China. And so it would be interesting to see if, in fact, Apple decides to go with them at some point down the road. Clearly, Alibaba is going to be coming out of the gate, but there's a lot of different AI features that Apple has, and it could be that they use one company for a certain set of capabilities and another company for another set of capabilities. Wouldn't be surprised at all if that happens, over time.
When do you think, Bob, in terms of timeline, you're an investor, you're listening to this, okay, when would Chinese regulators finally greenlight Apple Intelligence? Gene Munster, and you know Gene, he posted on X today, he said, I believe today's reporting from the information suggests a June or September quarter launch of Apple Intelligence in China. Does that kind of time frame, would that make sense to you, Bob? And when it does, are you in the camp that says, okay, when it does, you would expect to see a meaningful pickup in iPhone demand there?
Well, it's a great question. First of all, I mean, Apple originally said they wanted to have this in April of this year. So clearly, I think that's going to be a little tough to hit. But my guess is it may be closer to June, especially because, look, if it's September, we're already into the iPhone 17, the next generation, right? So logically, I think they're going to want to try and get it into this current iPhone cycle, which would suggest, middle of the year, roughly. And as to the impact, yes, I think it will have a relatively meaningful impact. But look, there's a lot of other questions going on. As I mentioned it in my first response there's a lot of geopolitical concerns with how Apple is being thought of and being treated in China. And again, we've seen a lot more focus on domestic brands. Huawei's gotten stronger, Xiaomi's gotten stronger, some of these other major Chinese smartphone companies. And there is some level of concern that will continue to eat away at Apple's share, regardless of what they do with AI. I don't think that's going to happen immediately, but it's certainly a factor I think a lot of people are thinking about. And I think you can't ignore it because it is certainly a possibility.
There's this interesting, you're kind of touching on it, Bob. I was talking to another longtime Apple analyst. He did raise sort of this question about Apple's business in China and whether, as he said to me, there has been perhaps a fundamental shift. And do Chinese consumers now simply move more to the home team, to the domestic brands, to the Huawei's? Do you see that possibly playing out?
I mean, it's already starting to play out, Josh. So yes, I think that is going to happen. Again, the question is the rate at which that happens. Those kinds of big changes often take longer, I think, than some people initially suspect that they will. But again, I think that has already started to happen. And that's why, timing is certainly important. The sooner Apple gets those AI features out there, the better, to kind of bring some momentum back to the brand. But these other factors are going on. No question about it. And again, as geopolitical situations change, which we're seeing happen every single day now, that could be a factor as well that really Apple has, unfortunately, very little control over.
Bob, always great to see you talking all things Apple on the show. Thank you, sir.
Thanks, Josh.
Stick around. Much more Asking for a Trend still to come. U.S. stocks closed mixed as investors assess tariff policy shifts and look ahead to fresh inflation data. And Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. We got to talk about Powell speaking first. He took the stage earlier today. He was in the Senate, and I went back in time. By the way, this is called the Humphrey Hawkins testimony. This has been done forever. It's twice a year that Powell, whether it's him or someone else, the chair has to go twice a year. So he's done this now 14 times before, and I looked at the seasonality of these days. And again, he does one day in the Senate, one day in the House, and sometimes it's reversed. But here I have day one versus day two. Day one is this white line here, and you can see it usually gaps up and ends just slightly in the red. And then day two also gaps up, and then it kind of has a different zigzag pattern, but ends the day turning up. And believe it or not, today actually kind of looked like day two, just a little bit if you shifted it down. The main point I want people to take away is that these days can look very different. We also have CPI tomorrow, which is a huge catalyst for the market. I've been talking about the S&P 500, the Nasdaq just consolidating for weeks and weeks. Is this going to be the breakout? We're going to have to wait and see. But before we move on, I want to also talk about Powell was mentioning debanking today. And this ties into an episode of Stocks in Translation that we talked about with Keith Bliss. And this is going to be released Thursday. He talks about the debank phenomenon and Mark Andreessen, the venture capital guy. So let's take a listen to this.
Debanking is real. It's valid. Andreessen is not just pumping up some conspiracy theory or dreaming about this. It's a real problem because today you still, even though there's a new financial system that's being constructed with cryptocurrencies and blockchain and digital assets, you still have the traditional financial structures that you need to interact with for an on-ramp and an off-ramp. Because still today, we're not going into your corner grocery store and buying all of your groceries with Ethereum or Bitcoin, we're buying it with US dollars.
And there you go. And so we do have that day two tomorrow. That's going to be coming. But also we have CPI, and that's that huge catalyst that we've been talking about.
Big headlines await. What about hot streaks in the market,
Ooh,
which I've been talking about with Julie? Meta was one, but I'm guessing what else you're looking at.
Yeah, so we had a big coffee streak that ended today. Meta's a huge one. That's still going, 17 days. I want to look at
17 days for
17
Meta,
days. It never had a Mag 7 that went up that far. I'm not a Meta man, but that is a boon for Meta investors. KC equals F is our coffee ticker, and let's just show that real quickly. Had a pretty big down day today. I'll show you a 2-month chart with some candlesticks so you can see had this incredible rise here, and this is leverage. Like, this is huge for a futures market. And then this big red candle there, I've seen this before, and a lot of times that is just the end, and you get a big decline from there. I don't want to call it ahead of time, but that coffee futures trend is over. Also over today is copper. Now, it was only up 6 days, but that's another big candle. And so I was thinking, that kind of tied into the China trade, all that. So that caught my attention. The copper, advancing copper, no longer a thing right now.
Copper in China, you've been talking a lot with us about. Any updates there?
Yes, so let me just get straight to that because I've been tracking what's happening in overseas markets since the inauguration, and let me put a 16-day chart. That's how many business days, that's how many trading days have elapsed since the inauguration. And I know this is an alphabet soup up here, but let me just break this down. These are all our international markets. HSI, carat HSI, that's Hong Kong, that's the Hang Seng. That is up 10% over these 16 days. IBEX, that's Spain. MXX, that's Mexico. Then we have Jakarta. Then we have the DAX over in Germany. Then we have China. Then we have this emerging markets ETF that a lot of people are familiar with, EEM. Only down the, you got France, you got the Bovespa in Brazil. Then we get to the Dow. Then we get to, where's the Nasdaq? Nasdaq is way down here, barely positive. So, and here's the Russell 2000, the small cap index in the US, barely positive there, actually just flat. So my big takeaway here is the rest of the world is doing just fine. It's the US, which has struggled a little bit, but I would emphasize we're going through sector rotation. We got that big catalyst tomorrow. We'll have to see what happens.
Fair. Final Jared Blickery point.
That was it, my friend. I am all out of points because once we cover the international markets, I am done here. So I can.
Did it surprise you the move we've seen in the international markets?
Yeah, because I don't think anybody would have said, okay, Trump's going to take office. International markets are going to take off from here. So yeah, surprise.
Thank you, buddy. Always good to see you. We're checking in on the hotel sector now. Some big names reporting earnings with Marriott today and Hilton last week. We're breaking down how to play the sector. Joining us now is Dan Wasilek, Senior Equity Analyst at Morningstar. Dan, it's good to see you. So maybe start big picture for us, Dan. You know, you look at this hotel sector broadly over the next 12 months, Dan. Are you constructive on that sector, Dan? You see reasons for optimism, or no, for investors who are listening right now, reasons for concern?
Josh, thanks for having me. Yeah, over the next 12 months, we remain constructive on the desire to travel. When you look at the long-term trend, you have hotel revenue per available room grow above GDP growth by a decent amount. So right now, the projections that we have at Morningstar is for GDP growth to be pretty healthy this year and next year. And so we would expect RevPAR growth to continue, although at a moderate level, maybe low single, mid-single digit type growth for some of the operators like Hilton and Marriott. Within that, we think leisure probably grows a little bit. That's the first area that really recovered out of the pandemic. But really kind of what's taken the reins this year would be group travel and then business continuing to recover.
Dan, I'm also curious, just get your take on the consumer. Given your coverage universe, you have really unique line of sight there. How does the consumer look to you, Dan? Because the economic data points we get continue to seem to suggest a consumer that's hanging in there, resilient.
Yeah, I mean, you could be concerned that savings rates are depleted. Consumer sentiment has kind of been volatile of late. But when we go back and we study historically the U.S. hotel performance industry and that revenue per available room metric or RevPAR metric, what we find is that as long as GDP growth is positive, and again, that's our view, that you tend to have travel demand outpace that GDP growth. So we've seen that in the past couple of decades. There's been periods where you've had robust RevPAR growth, despite maybe savings rates being depleted versus historical levels. Financing costs and interest rates being elevated. There's periods to point to, or that harmonize kind of with where we are right now, where you can point to those periods and say, yes, we can still have a constructive view on travel demand in 2025.
Dan, let's get to some specific names here. Marriott International did come under some pressure here today. It doesn't look like guidance for net rooms growth in 25, perhaps softer than some of the street expected. Dan, what did you make of that report? What did you see?
Yeah, so I mean, first of all, I think Marriott reported a pretty solid fourth quarter with a decent outlook. Probably what's at play here in our view too is that the stock has risen about over 40% since early August, and there's been a lot of multiple expansion in this name and some of its peers. So expectations were pretty high going into the quarter. But I do think, on the margin, their unit growth for 2024 was quite strong at 6.8%. And for next year, they're expecting unit growth or room growth to be 4 to 5%. And that was maybe a little bit disappointing, but that's coming after a pretty robust 2024 period. And then when you look at their pipeline, which is kind of a future indicator of room growth for the next couple of years, it's quite large. It's about 600,000 rooms or 500,000 rooms, which is 34% of their existing room base. So we do think that they can kind of have this 4 or 5% unit growth for the next few years. And that's above the long-term U.S. industry average of about 2% growth, just to kind of put some perspective on it. So their brands continue to resonate with third-party owners that want to join one of the Marriott brands.
Dan, another name I want you to take on, Hyatt Hotels. We heard today they agreed to buy Playa Hotels Resorts for about $2.6 billion. In your opinion, Dan, smart move for them financially, strategically?
I don't really think it moves the needle, despite the big acquisition price tag of $2.6 billion. Now, they're acquiring Playa, which is an all-inclusive resort, 9,000 rooms, 24 hotels. Some of those are owned. About 2/3 of those rooms are owned, of those 9,000 rooms. Hyatt plans to sell those rooms for at least $2 billion, I think, by 2027. So you have this acquisition price at $2.6. They're going to sell the owned asset part of this company for $2 billion plus. And what they're left with is owning some of those managed relationships and getting fees off of that, and then having the potential of growing this all-inclusive brand through Hyatt Zivas and Zileras. and getting management fees in the future. So to us, we don't think that it really changes what the fair value estimate we have on the company is 147. As far as capital allocation, being in the all-inclusive space, I think it makes strategic sense. And given that they're going to kind of recoup some of the purchase price by selling these assets, I think longer term it makes sense. That being said, I probably, maybe would have I'm interested to see on the call if there was other opportunities that maybe we're exploring. I think it's kind of a neutral to us.
Dan, appreciate your time and walking us through those stock picks. Thank you.
Thanks, Josh.
Stick around. Much more asking for a trend still to come. For our chart of the day, we're looking ahead to tomorrow's Consumer Price Index and what January means for inflation. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Well, January is usually the peak of the year, something pointed out by our friend Nick Timmeros over at the Wall Street Journal in a preview of the CPI data that we are getting out tomorrow morning, the Consumer Price Index, and the amount of inflation we could be getting on the headline level for CPI. Now, what do you notice about this chart, right? This looks at the course of a year or a collection of years from January to December. Well, pretty obvious here. In January, the numbers have consistently been higher. In 2022, we saw a 0.75% gain in January in that headline inflation number. Then in 23, 0.6%. In 24, almost 0.6%, a little more than 0.5%. Even in the pre-pandemic period where we consistently saw lower inflation, the average from 2014 to 2019 was about 0.3%. And then we saw it generally trend lower over the course of the year. Companies, when they come into a new year, they have a good visibility on what the last year looked like. They know if they can raise prices, if they have that pricing power. And that is when they tend to put some of these price increases into effect. And therefore, we have that effect that we have seen on inflation. Now, as for tomorrow morning's numbers for the month of January, that headline number is expected to come in at 0.3%, which is a little bit of a deceleration from what we saw in December. Will that then mark the peak amount of month-over-month inflation for the year? Of course, that remains to be seen. As we know, Josh, this is a weird year. There could be tariffs. There could be other things that could potentially affect inflation and make it a little more choppy. But it is interesting to consider that historical context and ask the question of what that seasonality is going to look like this year. Josh?
Thank you, Julie. All right, let's take a look now at what is trending here after hours. First up is Zillow. That stock is slumping after hours after the online real estate firm delivered a revenue forecast for its first quarter that did fall short of street estimates. On Monday, Zillow and Redfin announced a partnership, making Zillow the exclusive provider of multifamily rental listings on Redfin and its sites, rent.com and apartmentguide.com. We're also watching shares of Gilead rising on better than expected fourth quarter results. Biotech giant beating estimates on the top and bottom lines, and its full year guidance also come in above expectations. Company looking to come back after a major disappointment in its pipeline late last year. And Freshworks reporting a beat on the top and bottom lines for the fourth quarter, revenue growing 22% year over year. Software company also delivering an upbeat first quarter and full year outlook. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.